So thank you for coming in a short notice. In the trading, if we keep writing down the steps which work and remember it and maybe create a checklist, and so when the trade is successful, then we know that this is what this is the way I selected the trade, this is the way I executed, this is what I saw on that chart, and that was the market condition. So don't forget the market condition, because everybody is champion when the market is green and is moving. So the real thing, the real skill comes when the market is bad and you're not losing money. If you're not making money, you're not losing money. So that's where the secret is. So I try to um, document. So I document things. I write down the steps. So I'll show you some of the things I do or talk. So this is not the chart. I'm not showing you some charts. I'm not showing you some indicator. So all that is available maybe on YouTube. I'm showing you something more than that, not the indicator. Like, look at this indicator. RSI is here, and then when the stochastic go there, that's where you enter. Not like that. So I'm showing you something bigger than that. I can teach you all that. I have a 1-year coaching program, but which I plan to start soon. But I'm something bigger. So something bigger than showing you the line, because the next time when that line may not be there, and you're looking for the line and the line is not there, and you're waiting all day for that line to align. Like right now, Jim Cramer is talking about, okay, this is a bull market. The RSI is there, 12 month over the month, the market has to close over there, and the Fibonacci Queen is saying this. So all that, you know, so I don't do all that kind of thing. That RSI is there and the MACD is there and the month over month is there, and then the stock needs to break out there and then this that. So not like that kind of trading. So another thing where the traders they make a mistake is not focusing, laser focus on few stocks, laser focus on few techniques. So this slide, I'm showing you the slide on Bruce Lee. I'm a firm believer of Bruce Lee's quote that I practice one kick 10,000 times, not 10,000 kick one time. If I practice 10,000 kick one time, anybody can kick me out. I'm not the master. So I want to be a master of my thing. So when I am doing thing, I'm going with the flow. I have no tension, no tension. I don't have any panic. I'm not regretting. So so this is what it is. Practice one kick 10,000 times. I will send you the details of 1-year coaching to you, Mika and Andrew. So so practice one kick 10,000 times, and and then so I'm sure Bruce Lee know, and don't only practice one kick 10,000 times, but then practice the kick maybe when it's raining, maybe when it's sun shining, maybe um, standing on a little stone, maybe standing on a bridge, maybe there's nothing underneath. So practice those that one kick 10,000 times in all different environments. So traders don't do that. They don't practice the kick in all the environments. So in environment means uh, market environment for us. Also, this is another firm belief I have, that the big boys, they can operate in the dark pool, etc. But eventually, you can read the charts of the if you read the whole, if you can read the chart on the landscape, big landscape, on a weekly and a daily chart, so the footprints are there. So someone about 15 years ago told me, Noshi, dinosaurs can run but cannot hide their footprints. I don't know if this is quote, he told me or I read it. But he told me, but I don't know if he read it somewhere and then told me. So I have to verify this. So dinosaurs can run but cannot hide their footprint. So the moves happening in the market are there. Uh, so some are fake, some are real. So like for instance, the real moves happening in AI, Tesla, all these stocks. and recently in Beyond Meat. So I'm just giving you some examples, which just I just remember. So I believe in CVS now. The CVS has started a new trend. So knowing the dinosaurs are behind, then I can position myself. Um, I can position to be a long term in a long term like holding. I can position for the short term. I can, when they reappear and I'm already in the trade, I can buy another strike. So if I'm already in AI, let's say 37.50 strike, when then instead of selling it and I see the move is happening, instead of selling and I recognize the move is happening, I don't have to add to that 37.50. My job becomes how I can hold this position more. I may buy some shares or I may buy another strike out of the money. And I know let's say it's going to 50. So let's say I determine AI is now a $50 stock. So my job is to hold, to keep trading till it hits 50. So how I can trade? I can trade by whenever something new is happening, I add a new strike. So I can add a few shares, things like that. So the stock, when they are moving, when they are traveling journey, the journey is happening. You believe if you believe in the universe is expanding. So just like universe is ever expanding since the day of its creation, so the stocks, they show their behavior just like that. Expansion. So expansion in their moves, in their target. They just start out with a small journey where the dinosaurs just step in. So you position yourself, and then they move. The dinosaurs move. The volume or their activity expand the horizon of that stock. So the stocks establish new targets. So I'm just giving you the wording. I am not showing you any charts. They expand. So the targets expand. So you need to go to the monthly chart and weekly chart and see if there is any expansion coming in the target. So for instance, the AI, um, this morning, the way it was, I already have a position, my members have, and then we started to move. I could detect immediately that, okay, it's a $50 stock now. So $50 stock, how can I take advantage of this $50 move, because I know that the move is is expanding. Also, so when the move is expanding, when the stock is also trading in a is uncharted territory. So when the stock is trading in an uncharted territory, it's hard for traders to uh, figure it out where the target is. It's easy to figure it out the target when the stock is not is trading in a previous the horizon where it has traveled before. But if the stock is going beyond, like in a different universe, expanding, then you need techniques to detect and measure where it's going next. Where is the ultimate target right now, short term? So for now, right now is 50. What the stock will do at 50, I don't know. Maybe it's going for 75, who knows, or 100. So focus on the move dinosaurs are um, creating. Now, another thing, I don't need to master 10,000. So this is what it is. I don't need to master 10,000 kicks. I keep repeating. So in the early days, I focus on the key chart patterns, the patterns which work. So I will list down some of the patterns, some of the things which I'm looking at during the day. And when I see it, recognize it, feel good about it. So you need to see it, you need to have a way of seeing it, and then you need to say yourself, this thing is, I recognize it, I have seen it before. So when I have seen it before and I see it and I recognize it, and now I need to remind myself, am I feeling good about it? So if I'm not feeling good about it, then I need to ignore it. I need to ignore. So remind myself that I see it, I recognize it, it's familiar, I have seen it before, and I'm feeling good about it. So this technique I learned. So now you will say, okay, what it has to do with So this one I learned from Rhonda Byrne. Rhonda Byrne is an Australian writer. She did some research, came here from Australia and did some research and talked to the top people. So they taught her. So one of the technique they say is in anything. So even if you're buying a house, so you can apply this technique in anything. See it, recognize it, looks familiar, and now I'm feeling good about it. So when I'm feeling good about it, I don't create any other scenarios. I prepare myself to take action. So early days, I um, learn to master a few chart patterns. Few, not, and the few doesn't mean only three or four. There are dozens, more than dozens, but um, most of the charts, they are most of the stock they are doing exhibiting the same. You can put a dog on the chart, a symbol dog, or you can put a cat. So and you don't need to ask somebody show you the chart. You don't need to ask, can you tell me which symbol is this? No, I'm not telling you. Just tell me how would you act upon it? Maybe it's a coin flip. So you just say, okay, it's a coin flip. I can flip the coin. It can go up next day or it can go down. But what's the odd of it's going up and going down? So behind what was happening when you saw it? So don't need to know the symbol. It can be a dog or it can be a cat. So master those key patterns, and then you you need to know about yourself. So there is another two three slides which I talked 3 days ago. So just think of that is you. So you are different than any other person in this world. So you're trading the market. So only you know yourself, who you are and what you're trying to achieve, and what's your age, your financial objective, and your previous experience, etc. Then you come to the market with that objective to use you come with the market with that objective. Then you study the market condition. So when you understand the market condition, this is the market and this is the way I will trade. So then you decide, okay, this is the market, then I'm trading this way. So what trading system I use, what I'm trying to look. So what kind of a chart pattern I'm trying to uh, looking in this kind of market. So the market, let's say, which is they call it bull, the market which is uptrending. So then you ask yourself, okay, the market is trending to the upside, but for how long? So a lot of stocks maybe already moved. So I don't want to chase those, like for instance, maybe AI or maybe Tesla. So I don't want to chase those which have already expanded, like going crazy, like Oracle maybe. So don't want to do that. So what I'm looking for, maybe I'm looking for those stocks which have not started to move. Maybe I need to keep an eye on Amgen. Maybe I need to keep an eye on Nike. Maybe I need to keep an eye on CVS. So those which have not moved yet, they are still behind. So those kind of things, maybe I need to find some new hidden gem from small caps, because the market is moving now. Small caps are participating. Maybe I can find some hidden gem in the small cap. So I have a list of the small caps. So let me find those stocks. So so depending on the market condition and how long the trend is there, I need to adopt my strategy. So it's me, then is my trade market condition, then is ask myself how long the market condition is there, and where are the supports and where are the resistance, and what else is there. So I have a different baskets of stocks, mainly. So I call it hardcore stocks. Hardcore stocks, like they are right now 210 or so. So hardcore stocks are those stocks which are in the news. They are moving. If I find something new, I add it into that stock. These are the stocks which, based on the average true range, optionable, $1 million, not $1 million, 1 million shares. They are active, they move in a group. So these comprise of financial stocks, technology stocks, the oil stocks, the chip stocks, the construction stocks, the mining stocks. So all these Home Depot, Caterpillar, Baba, Baidu, some Chinese stock, all these they are there. So I don't want to miss the move in those 200 stocks. So every day, if I'm looking at those 200 stocks, I know they are there. So we traded Baidu, and then we exited at some target. And I was just watching Baidu every day. I'm saying, okay, Baidu, what it's doing? It's facing resistance. Today, I know now it just gapped up. Something happened, it gapped up. So missed that one. But I know Baidu is there. So every day, if you focus on a 200 stock, you will find something. You have some open position. You need to add to the existing. You can add some more to the existing position. You don't have to go beyond these hardcore stocks. And then there are some core stocks, about 250, which I look at because they comprise of the market, main market, S&P, etc., Dow Jones. So all those stocks which are in, let's say, Dow Jones, S&P, some of them, some from Nasdaq. So even though I'm not trading, but I keep an eye on them. And then there are non-core stocks. So non-core stocks are like Verizon, AT&T, GE. They move 25 cents a day, dividend stocks. So I just keep those. And then this basket is expanding. So when the market, small cap stocks, when the market is, um, what about the option timing? Yeah, so there's the option timing, when to buy and sell. So I will explain to you. This is the skill. Uh, Buy and sell. Keep falling on me. I don't know what you mean by keep falling on you. So that's what I'm trying to explain to you. Something you need to learn. Yeah, it's a very sad story. People lose every day. They just want to buy. Especially, I tell you, especially Asians. I don't know something about Asians. They just want to lose money. Or my homies from India, Pakistan. They just come to the market to lose money. If I combine all the Asians I know and all the Indians and Pakistanis, I think, and I say, okay, how much money you lost? Write it down on a piece of paper. And I wish all of you would have known each other, and you would have just contributed in a big pot and said, okay, we take the average and give it back to each other. So like, let's say 100,000 Asians or Indians, Pakistani, they all combine and they say, okay, I lost 10,000. Okay, I lost 100,000. Okay, I lost 200. I lost 5,000. So, okay, everybody write down the numbers, prove it that you lost. And then let's take the average of that number and give it back to you. So, so you don't have to trade, just take the average and take it back home. So that's what it is. So just be I just started. I'll explain some. Maybe you would learn. So use so move on. Just wait for a while. So a small cap stock are those. So when the basket of the small cap, when my basket of the small cap stock expand, I know there's activity going on, and I need to pay attention to the small cap stock also. They move. Small cap stocks, they move at the end. But there is explosive growth. So because they are small, they explosive growth is they move 50%, 100%, 200, 400%. But not all the small cap stock needs to be bought. So people allocate their fortune. Don't follow. Just can you stop, Juan? You're bombarding my chat. So please stop writing things. I pay attention to the question, so I get distracted. So please don't write any more your comments. So small cap stocks are, so what the traders do, they just allocate their whole portfolio into small cap. So when they allocate their whole portfolio in this small cap, that's where they get clobbered. They make money, but then small cap eventually come down 50% or 75%. So you need to allocate a small portion to the small cap, not everything what you got in in the small cap. You need to allocate a small portion to your option trading, not everything you have. So people don't do that. They just whatever the money they have, they just buy Tesla. They keep making money in Tesla, and then eventually the music is stock, or they keep trading Apple or whatever is the stock. They will keep trading AI. I know they keep trading AI, and then eventually the bottom will fall. So don't do that. Don't trade in the same. Another mistake. I'm talking about the mistakes now. So they mix um, all kinds of trading in just one account. They open one account and they mix everything. They trade options in it. They are trading a small cap. They are buying shares in it. They are doing all kinds of things in just one account. They're trading weekly options, and the time is running out. So don't do that if you don't know what you're doing in the weekly option. So so don't do all these kind of mistakes. Don't just open one account, put some money, and start trading weekly options. Start buying Tesla calls. Start buying only AI calls. Trading some small cap $2 penny, dollar stocks, and buy at $1.30 and hope it goes to $3 because the guy is telling you this buy this shares, it will go to $3, and then it goes to 25 cents. They get money to pump and dump. So don't do all this. Another thing I have the list is indices ETF. So the if you don't know where the indices ETFs are, like Dow Jones, DIA, SPY, TQQ, IWM, then you cannot read the market. So you need to have a basket of these ETFs and watch them, see where they are in the landscape. Maybe you trade some of them. To the beauty is to find out which ETF will move out of this. Is it DIA? Is it SPY? Is it QQQ? Is it IWM? So for me, it was QQQ. So out of this, QQQ, semiconductors ETF, if they are moving, maybe pay attention to the semiconductors ETF. Gold and silver, the time comes when the gold and silver stocks start to move. So have a list ready for the gold and silver ETF, and the gold and silver stock, selected stock, need to be prepared in advance, must have a list ready. So when the time comes, then you can open that list and see which one is moving, and then you participate in it. Inverse ETF, if you have one trading system, if you don't have multiple trading system, the trading system to go long, trading system uh, to go long, and trading system to go short, then you just have a one system for trading long. So if you're comfortable in trading long, then you make a basket of inverse ETF, and then inverse ETF move opposite of the market. So if the market is going down, those ETF are moving up. So just apply that, whatever your technique is to go long, you do that. So I don't trade forex. I just trade stocks and options. So be ready for all these based on the basket. Be ready when the oil is moving. Be ready to pull out your symbols on the oil. Be ready when the technology stocks are moving. Be ready for when the you identify that the Chinese stocks are moving. When the Chinese stocks are moving, look at Baba, Baidu, and others. The one they move. So see which one is still have a potential. So do this kind of homework before. So once you have a market, once you have the baskets of all this ready in your and fed into your system or in your platform, and you understand yourself, and then you understand the market environment, then in the morning, your job becomes to identify which stock. So price discovery. So the price discovery could be through the black box. So the black box is just some indicator maybe you bought, or maybe you bought a trading system which puts the green arrow and the red arrow. So make sure you understand the logic behind those green arrows and red arrows, and make sure you understand in what environment, market environment, that black box was tested, and what else happened. So all that. So make sure you understand the time frame for that black box. People buy indicator, and then the they show, let's say they show the indicator on a daily chart, and buy the black box and put that black box indicator on a 5-minute chart. So when we put on a 5-minute chart, I will see a lot of green arrows and red arrows. So now I'm confused. I buy, and then it goes the other way. Then when I sell, it goes up. So maybe there's nothing wrong with the black box. It's just that you did not understand to implement it properly. So make sure you understand how the black box is operating. in what market environment it was tested. Not just one market environment, in a various market environments. So make sure you have a history and test it. So and then you go through different market environment and you test it. If not, then maybe black box is not good for you. Maybe you pay attention, you learn, you spend time to learn the chart patterns. And so this is what I did, chart pattern, so for last 15 years. So focus, laser focus, like Bruce Lee, and learn what you're comfortable and you can identify. And just a second, Juan came, needs to go. He left. Finally, he left. Juan came, bombarded, and then he left finally. Okay, gone. So okay, thank you. So now another one is a band trading. So band trading I don't do. Band trading is you know the Bollinger Band. When the stock is moving above the upper line, then it's going to another universe, or when it's going below the bottom line of the Bollinger Band is breaking the support. So I don't do that kind of a trading, band trading. I don't do that. I do the trend trading. So trend is my friend, but till the trend ends, right? Most of the traders, they they make mistakes in trend trading. They identify the trend very late. Uh, Either they are catching at the top or trying to catch at the bottom. They're going short at the bottom. They fail to understand the change in the trend. They don't they don't understand the like detection of the trend. So they don't understand that the change is happening right now. So for instance, for me, there is a change in the trend in the CVS from bottom going down towards the new uh, to the upside. So if I understand that, and then I will keep following CVS till it tells me that it's topping out. Now, the key for me in the trading is this, knowing the support and resistance. So traders need to pay attention to the support and resistance level. They need to spend time on understanding the support and resistance, where the resistance is, where the support is. So this helps in support and resistance. Is support means there is a demand zone. Resistance means there is a supply zone. So knowing where the demand is, knowing where the supply is. Support and resistance are created based on the previous market actions. So this is where the battles were formed. So if the previous battles were formed and you can read where the battles were formed between the buyers and seller and what was the psychology, you may be able to time your entry correctly. So you may be able to time your entry correctly. You may be able to add more to your existing position. You may exit little early as soon as you recognize that there is a resistance and this is where I exit. I need to exit before it moved down. For instance, AMD. So AMD hit the target resistance and I need to exit. So you need to exit from the AMD. It tells you. So if you look at the daily chart, AMD tells you that it's temporary, it topped out. So I don't know, maybe it will start move, it will show, then I will get back in. So understanding the support and resistance help me in entry. It helps me in a re-entry. It helps me in managing my loss. It helps me in maximizing my gains and all that. It helps me in getting out of all the at the proper targets. The breakout. So I like breakout. So breakout must happen. The breakout must happen. So the breakouts, different breakouts. The 52-week high breakout, it could be a 21-day breakout. It could be a breakout from the consolidation zone. So I like trading the breakouts from the congestion zone. So congestion zone means there is a resistance, there is a channel there. So the stock is trading in a channel. So the breakout happens, suddenly the stocks breaks out of that resistance zone. So when the stock breaks out of the resistance zone or it jumps, there is a gap. So the breakout is happening with some kind of a gap is and I can read the gap is happening above the resistance, so then gap up with the breakout. So the stock gaps up and then it breaks out. It is running with the volume. So no, combine the gap up with the breakout. gap down, combine the gap down. So it's the stock gaps down certain key levels, and then it's breaking down with the volume. So 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 you can combine the um, uh, one or two strategies into one. There could be a reversal breakout. So the stock pull back for few days, like 3 4 days, pull back. So the stock is pulling back. Then it comes to the support level, some strong support level, and then it's reversing to the upside sharply. So that I call it a reversal breakout. It's not listed here. So that is a reversal, sharp reversal breakout. So I like the sharp reversal, and it's making a breakout, meaning now I know where the I have the confidence in my entry, because I know where it pulled back after reaching a certain level, and now it's reversing sharply to the upside. So the reversal breakout, the gap up reversal, I don't do the gap up reversal, especially when the market is bullish. I don't do that. When the stock gaps up, and then I say, okay, the stock gaps up, and I need to fade the gap. There are 200 stocks in my basket. Why I bother and show myself uh, that I'm a hero? I can trade gap up reversal. I don't do that. So only when the market is really tanking and a stock gaps up, and I know it hit the resistance, or it did not even cross the resistance, and now it's pulling back sharply, and I'm looking for this quick move. But I don't do this kind of trading. Gap up reversal, I don't do. I try to follow the trend. Gap down reversal, when the stock gaps down. So when the stock gaps down, it's very tricky. Gap trading gap up is easier than trading gap down, because gap down, when it occurs, in my opinion, so I'm giving you my belief, when the gap down occurs, uh, it could occur due to any news, bad news. Some bad news came and it gapped down, and it gapped down and gapped down, and then it's just moving down. And then suddenly the big boys come and they start buying, because they think this is the fair value. And then I start to lose the same day. I buy puts or I short, and then I start to lose the same day. So instead of if the gap down is occurring at the key level, and I know that, okay, this is the resistance and it's breaking down, then I go towards the puts. Or if the gap down has occurred, like recently it did in, I think, in SLB. So oil stock, there was some news, and then all the oil stocks were just gap down, and they were moving down. And then I was watching them. So see, I'm not going to short, but I'm watching which one of them showing the sign of the reversal. So the sign of reversal will, if you're watching those stocks which are gapping down, and you think that this gap down is just overreaction, then watch those stocks on a short term time, like 5 minute or 15 minute. So when you may be able to catch it, a quick move to the upside, and then combine it with the option. So I do that: gap down reversal, and gap up and gap down, not gap up reversal. Intraday reversal. So intraday reversals, if some news came and the stock is tanking, and then positive news come, and then the same stock is reversing to the upside, knowing where it's reversing from, what key levels, but and if it's a strong support level. So when I recognize that, if I am in the trade, I add more to the position. If I'm not, and so I ask myself this question: if I'm not in the trade and this intraday reversal is happening, is it okay to initiate a little position, a little one, maybe dip my toe, and when the confirmation comes tomorrow or the day after tomorrow, then I can add more to it. So if that is the situation happening when I am not 100% sure if this intraday reversal will last, I just initiate with a little position and then add when the confirmation comes. So there are different techniques, different chart patterns which show the intraday reversal, and then there are techniques and confirmation comes afterwards, next day. So what kind of a confirmation I'm looking at? When that confirmation happens, then I add more to the position. Moving averages breakout. So I don't do moving averages breakout, because uh, moving averages is just a moving average. So think about it, moving average. So what is moving average? So you take any number of days. So who made those number of days? There are 365 traders, so there are 365 moving averages. 21 moving day moving average, 20-day moving average, 50-day moving average, 200-day, 365, simple moving average, exponential moving average, weighted moving average, adaptive moving averages. So what moving average is working? So what moving average, the crossover moving average, the short-term moving average, the 3/8 or 8/20 or 20/21, what is there? So if you know moving average breakout, so all I do is I watch the short-term moving average. So I give you my example. Short-term and a few moving average. Sorry, not the short-term, few, which are known. So like a 200-day moving average or a 50-day moving average, just to see where it is in this in from the moving average point of view, or maybe 10-day exponential moving average, just to see what else is going on in terms of moving average and what others are looking at. So if I put a symbol, so think about this. If I put a symbol on a day chart and it's moving, and if it's not moving, breaking out on, let's say you have defined 20-day, 21-day moving average, would you not trade that stock if it's not making a breakout from a 21-day moving average? Would you move the curse, the moving average below, and then you say, hmm, so this stock is moving, having a breakout on a 90-day moving average, not 21. So next time I will adjust my moving average to 19. And then after a few days, you see another stock moving, breaking out on a 21-day moving average. Then you say, okay, this one is moving on a 20-day one moving average. So no, I don't do all this nonsense. So this is all nonsense. So I don't do moving averages breakout, but I do watch 20-day, 50-day, 200, just to see how bearish and how bullish the stock is. So do that. So now there are 200 stocks. So all of them are running in the morning. So how do you create peace? So when you're trading, you need to be at peace. Lot of traders maybe um, have a. So first of all, if you have a job and you are working and then you're trying to trade, you cannot do the job compared to the person who is focused on just on trading. You cannot. You cannot trade from office or try to trade from the phone and open an app. You can trade on from the phone on the app if somebody is giving you to buy and sell. So that's, I send you the alert. So maybe you can do that. But if you're trying to trade based on the app, eventually you will lose. So Robinhood app and etc. All that. So don't do that. Traders just try to trade from the app. Don't do that. Imagine all the big boys, all the top traders. Are they just trading from the phone app? Think about this. You just giving making money from one profession and bringing it, feeding to the big boys, the dinosaurs. So in the morning, that too many stocks moving. First of all, there are, let's say, 10,000 stocks. I'm not watching those 10,000 stocks. I'm just watching my 200 stocks. And even on top of the 200 stocks, then I'm applying my volume filters. I'm applying my price filters. I'm applying my average true range filters. So I'm applying the filters. So when I apply the filters, then I can list all this. I can sort them. I can sort them based on which one I need to pay more attention, and then I'm applying the filters on a different time frame. So what time frame? It could be a weekly time frame, it could be a daily time frame, and it can be as low as a 5-minute time frame. So 5-minute time frame is giving me little heads up. Maybe I'm trying to enter, so I'm watching the 5-minute chart. Maybe I'm trying to exit, so I'm watching 5-minute chart. But the bigger time frame, maybe it's a 60-minute time frame, so I can see clearly what is happening on a 60-minute chart or 65-minute chart. And then the landscape, the full landscape, is a daily chart. So when I apply the volume filters, such as it could be absolute volume, it could be relative volume. So I'm applying all these filters. So when I apply the filters, the stocks, it's like, you know, you put the what you call when you are washing, let's say, vegetables or something. So you don't want the vegetables to go in the drain. So you just want the good thing to stay on top, and everything goes down. So all the stocks which are not meeting the criteria volume, they are way below, and only the top 5 are on the top. So you do that filter. If so these 200 stocks are already filtered by price. So I already know they are filtered by price. I don't need to put a price filter on those 200 stocks. But if I'm watching like 2000 or let's say 5,000 or 3,000 small cap stocks, so then I'm putting the price filters there, because I just don't want to trade the stock which is $1, because if I buy $1 stock, it will go to 10 cents before it go to $1.10. So I don't want to do that. I bought 10,000 shares, loaded up at $1.10, and it's not going to even if I buy at $1.10, it's not going to even $1.21, because that's where you bought. That's where you saw this. That's where they do. If you don't apply proper filter, if you don't know what you're doing, so sudden spike in volume and don't know where the spike is, which chart you're looking at. Maybe you apply the spike in the volume on a 1 minute chart or a 3 minute chart. So you saw a sudden bar. Maybe you're subscribed to a newsletter and they send you this garbage because they get paid for sending you this information. The sponsor, the owner of that company, he's paying. So they send you the newsletter. There's a sudden spike. You see that on a 1 minute chart. So you get trapped, and you buy a dollar stock, $1.10, and it doesn't even go at $1.11. Not even $1.11. It goes to 10 cents. So I don't want to. When I'm trading a small cap, I'm very careful. I need to be very careful on a small cap stock. So apply the filter, and make sure it's trending properly. Also, another filter I apply is the average true range. So average true range is on average, on a 14-day average, how much the stock moves in general. So when it moves, if it has covered 60, 70% of the move in short term, like in 1 hour, 2 hour, then I know there's something going on with that stock, because on average it moves $3, and it has already moved $1.80, and only 30 minutes has passed. So something is happening. And then when I combine the average true range filters with the volume, so then I can read, and I know. Then I go on a day chart, and I see the full landscape, and then I go on a smaller time frame, and try to mark time my entry. And simultaneously I'm also looking at the option, so what is happening in the option, etc. So combining the average true range filter, already know the price of the stock, combined with the volume, then sudden move is happening. So the move, when the price is moving, if nothing, anything about that stock, you don't know anything about the stock, you don't know the volume, you don't know the filter, you're just reading the price, you just, it's right there fluctuating, you could tell there is something happening with this stock. It needs further merit. So you need to develop that skill, that the price is blinking and you can see that something is going on with this stock. I need to look at it. Now, regarding the volume filter, maybe I will cover in detail in another. I will show you in detail what I do, but just to explain, the volume filter is is very important. So I just had a coaching session 1 week ago, 2 weeks ago, on the price and volume. So volume needs to be paid attention to besides the price. So if you're just reading the price and not analyzing the volume, you're just doing, let's say, uh, 50% of the work in trading. So combine the volume with the price. So volume, not just look at the absolute volume. So if I divide the volume, I need to put A, absolute volume, B, relative volume. So A on the absolute volume, meaning if it trades on 1 million share per day on average, and it's already trading, let's say, 1.1 million. So on an absolute basis, it's trading at 10% above its normal. So it's trading 10% above its normal, and only half of the day has passed. So the remaining half of day, by the time it's done, it may be trading, absolute volume would be 200% or 100 or 300%, whatever it is. So I have that data. I pay attention to the absolute volume. Another thing you need to pay attention is the relative volume. So the relative volume, you can time segmenting the volume. So time segmenting, based on any given time interval. So I divide the time interval into 30-minute segments. So just think about it, there are 390 minutes. So I just divide 30-minute segment. So from 6:30 a.m. Pacific to 7 a.m., then from 7 a.m. to 7:30. So I do this time segmenting. So if I do the time segmenting and apply the relative volume, then I know based on the previous data, average volume, it trades on a, let's say on a 30-day average, moving average. So on a 30-day average, this stock moves this much. This is the average. On a and each day has 390 minutes. So if each day has a 390 minutes, then I can divide that volume by number of minutes, 390 minutes. So I know on average, stock trades per minute. This is the volume. And if 30 minutes has passed, so I multiply that 30 minute by one, and then I know that on average, during the 30-minute, this should be the volume, and it's already trading 400%, 500%. So it gives me some uh, other confirmation, some kind of a confirmation that is trading relatively at a higher volume for that time segment. So let's say I'm looking at the stock at between 10 and 10:30 a.m. Pacific time. So calculate the number of minutes passed and then apply the average, divide that average by that number of minutes, and then I know that at this time segment, this should be the volume of this. This is on average, and it's already trading at this certain volume. So when I get that data, it helps me in finding my entries and exits. If I'm already in the trade and the volume is high, before exiting, I need to remind myself that the volume is high. As long as it's not a climax volume, there is expansion happening. I need to hold that position. So all that goes on by applying the filters and the volume. Now, so all this is happening. So I have automated a lot of stuff. So there's a lot of stuff I've automated. I started with the manual like 15 years ago, especially 12 years ago when I started full time. Everything was manual. Now a lot of my things, what I'm showing you here, they're all automated. So I get all kinds of alerts. My background is in IT, programming and system development and process implementation. So my brain works, and then love of the trading and technical stuffs and anything. I'm a big picture guy. I'm a detail oriented. So I'm very detail oriented, and I'm a big picture also. So at the same time, so you need to be big picture person and a detail oriented, and bring the creativity in any profession. If you're not creative, you will do perform on average. So be creative. So just giving you something. So these alerts are triggering to me, and I am aware of. And I have a help. So now I have a assistant. You can say my assistant. So trading assistant. So they are informing me. I have two of them. So they're informing me all this thing is happening through voice. So communicating with me, telling me that this is happening. They are trained, and so I laser focus on my trading and getting the alerts on the side. So explain to you. So these are some of the alerts I have set up in my system, in my trading system. So this is called opening range breakout. I learned about this. So opening range breakout is something like, for instance, this you have 200 stocks and they all start to trade. The market is pre-market. You saw that futures are up. The market will be green. So you note down all the levels of the market. So you know this is the level pre-market. You know all the support and resistance. You have done your homework. You understand the market conditions. So I run my algorithm overnight. So I've developed another system where I run my algorithm. It takes 6 hours to feed the data and run and analyze the four markets. So I provide you that report. So I know every day I know the conditions of the market. So if something else happen, it's okay. Some black swan event occurs, but at least I know 90% confident that this is the market condition, this is the strength, this is the volatility, these are the three trends, they are all upward, my best bet is to go towards the market. So I do all that. Then in the morning, when the market opens, so there are 200 stocks. I'm laser focused. First of all, I'm laser focused on my open position. I don't care about the new position. I need to see first the old open position. So I'm monitoring my open position, which one pre-market. So you need to watch the pre-market condition. Pre-market, you get the alert. Okay, AMD is moving up in the pre-market. Okay, I get the alert. AI is very active in the pre-market. Okay, we need to pay attention when the market open. Do we have open position? Yes, we have. Okay, yeah, I know you have. Okay, as which one is moving? The Caterpillar is going up. Okay, we have a position. No, we don't have. We have a vertical spread position. So all that goes on. And when the market open, I just narrowly focus on my open position. I don't want to see what other positions I can open. So first take care of the exits. Once we take care of the exits, at the same time, so I have 14 monitors here. So on one of the monitor is the opening range breakout. So opening range breakout means that at a time defined, I know that this stock is making a new high on after 15 minutes. So the 200 stocks move, 15-minute pass or 30-minute pass, and it's still moving above. So I get the alert that 30 minutes has passed and this stock is further moving upward. So that stock needs to, I need to pay attention. And the relative volume, so when I combine the relative volume on that stock, which is moving beyond the 30-minute high, and the relative volume is higher, then I need to pay attention to that stock. So I get that alert. So I start making my list of those stocks. Now, anytime a meaningful new intraday high is made, I need to pay attention. So for instance, if the stock opened at 100, it went to 101, it made a high, significant high. Based on my definition, I get the alert that, okay, it's trading at 101 now. And then after 2 hours, it goes to 102. I get the alert that now it's trading at 102. So it's a new intraday high. Same thing is a new intraday low. So if I have a long position and it starts to make a new intraday low, I need to pay attention to that new intraday low, what is going on. Percentage up, percentage down. So there's a different metrics. I've defined the metrics that if the stock is trading in this range, I need to have a and it move up this percentage, I need to monitor that. So I do that percentage down same way. If the stock is $100 stock and it moved down 2%, I need to pay attention. But if it's a small cap stock with trading at 10 and it's moved down 2%, 3%, it's meaningless. So for a $10 stock, if it moved to 3% down, it's meaningless. So depending on the price range, the percentage move is bigger or smaller. If the volume is 30% above, I get the alert. I get the alert that, okay, absolutely, it trades at 1 million share and now it's trading at 1.3 million. So I need to know, look at it, especially if I have an open position. Above average volume, unusual volume, below average, all that I need to pay attention. So breaking above the resistance. So all the support and resistance I define at nighttime for all the open position. So if the stock is breaking the resistance, so the resistance also, so not just a resistance is just one line. The resistance is a lot of programming done, a lot of analysis done. So it's instead of doing manual, now my program does it. So what kind of a resistance? Is it a strong resistance? Is it weak resistance? How long was the resistance generated? At what is the range of the resistance? All that I get the alert. So program that one. Breaking below support. So if the same thing, same concept for support. So what kind of support? Is it a weak support? Is it strong support? Is it, how long was the support? What was the volume? And all this support levels were generated. What is the support below the support? So if the stock falls, let's say the stock falls from is falling from a fifth floor. So if it's falling from the fifth floor and I see the support is at the second floor, okay, it's already on the third floor, so it's reaching the second floor and I have a position. So how is there any other support? Is there a basement below the first floor, or we call it ground floor? So this is the ground floor, G, written on the elevator, G. So you have a G and then you have 1, 2, 3. So when you ask the programming, then you fail, the G fails there. You can mix it alphanumeric. It's hard. So American system is very clever. 1, 2, 3. What is G? So if there is a basement like B1, B2, B3, so I try to understand if the position is running away from me, then I go and analyze that what else I have. Where is the support? And then if it's a sharp reversal from a resistance, so if I have a position and it's hitting the resistance level, and I already know the resistance level, and it just when you open most lot of stocks, when they gap up, they just gap up to the resistance level and they just sit there. So at that time, I need to decide whether I need to close the position, take the profit, or I wait for more. So I have to remind myself that this is the resistance and the sharp reversal can happen. I can lose all the profit. I need to switch this chart to 5-minute chart. So knowing the resistance level in advance and reminding myself at that time that I need to switch this symbol to 5-minute chart and be ready to close the position. So close the position. I don't close. So on my phone, on my iPhone, which is needs to be charged at night time, fully charged, fully functional. The function of my iPhone is to open my platform and exit that position. Whereas I'm monitoring it on the monitor. So the monitor is a big monitor, like 27-inch, and but laser focus when closing the position, close from the phone. So that's the purpose of the phone for me, and it works very well. Same thing from sharp reversal from support. If the stock, I define the support in advance, and if the stock coming down sharply from the support, then I'm watching if the support is being held, then I may add to some more to the position and build up my position there. Just don't sit. So traders, they get paralyzed. They don't add to their position. So recognizing is that where the support and resistance gives you an edge to build up your winning position. Now, another thing, crossing moving average from below or above. So I do that for 50-day moving average, for 200-day moving average. So you need to just monitor those big moving averages because the other guys are monitoring it also. So you need to, there is something called wisdom of the crowd. So if the crowd is watching something, you need to watch that too. If you don't, uh, if you try to be in isolation, you may not be profitable. So make sure that you also watch that which the crowd is watching, because most of the time the crowd is right. So there's something in the wisdom of the crowd. So let's say I do all that. So I did a lot of work. Then now you say, okay, you work very hard, but a lot of things are automated. Yeah, I do work very hard. That's if you don't work hard, you don't make money, and you don't make help others to make money. To do all that, it's all in real time. So it's not something I say on Sunday night. If you subscribe to my newsletter, on Sunday night, I will send you one pick which may make you money in the coming week. So you see, so I don't do all that. So I don't know. I don't have any stock to tell you on Sunday night that you buy this on Monday morning, because that may be the stock only God knows. I don't know what will happen. I need to see real time. So make the decision real time. So when I'm looking at it and then I say, okay, this is the real time meta calls, I see meta going up and I need to open a position. So this is just for example's sake. So let's say I see this, I say, okay, July 230 call, buy at $10. So this is simple alert goes to you via SMS if you have subscribed to SMS, or simply email. Email delivers as fast as SMS. If you have set up your proper system like Gmail on your phone, it's the same. SMS and Gmail, they deliver at the same time, so you don't need SMS. But if you want, you can. So this is only thing I say in the subject. Meta calls July 230 buying to open at 10, and then in the email body you have further detail, and pay attention to detail. It's a third Friday expiry option, so third Friday, so we buy third Friday. So I do that. So only this alert goes to you, and then next alert comes as a for the targets, and then comes other details. And then I do some fundamental research and I tell you. So I don't. You can say if we are a short-term trader, you're not reading how strong it's fundamentally it is and all that. Maybe it helps you to buy those, mm, open the position in those buy options, the stock which are fundamentally strong. Maybe you can build all the list. So, for instance, Apple, Meta, Tesla, but the same fundamental stock they go down also. So you wonder what happened, where are the fundamentals. So it depends what kind of a trader are you. But I read reports, um, but not. Um, it's not like, okay, I read the report first, find somebody, because if I'm reading the report, there are 10,000 reports. So if I'm basing my decision, there's always somebody who's saying how bad this stock is, and everybody should sell, and it's just going up. So I don't want that report to cloud my judgment. So I'm basing my decision on what is happening right there on the chart, what I'm seeing, not some report. So when I send you the alert, you can put the limit order. So that limit order is not some kind of a order I'm sending you which doesn't exist. The price doesn't exist. I just send you a half hour ago price. So no, not that. Is the real price. It's right there, and you can execute 99% of the time. You will get fill at that price. It's not something which is going crazy. Maybe sometime if you miss it, so you wait, or you buy one or two contract at the higher price, little higher, and then rest you buy later. So these are some of the tips for the limit order. So watch your limit order to get filled. You cannot walk away from your limit order. If it doesn't get filled, you cancel your limit order. Don't try to chase it. If the option was trading at $5.20 and it's trading already at 6, and you just open your phone and you say, okay, I am buying it at 6, and I buy at 6 and I will sell at 6.20. So that's what a lot of traders do. So don't do that. The stock which I'm sending you alert, they are trading in a narrow range. It's not like they're exploding. Some of them, like maybe we already in the trade, for instance, today happened in AI. So there was a sudden burst, and I sent alert to buy more at a higher strike price. So if that's most of the stock, they're trading in a range. I send you the targets. I call it green, yellow, and red. So you pay attention to the target. Um, the targets are there. So just look at the current price and the target. If you miss the trade, don't buy, don't chase it. There's another trade. So pay attention to the yellow target. Pay extra if you see the potential between the current price and the yellow target. Maybe you can pay a little extra for your option, but don't do that. Shave the spread. Always shave the spread. So there is something called show or fill order. I've written an article I sent you a few weeks ago. I can send you again, or you can send me an email. I will send you again, and I have a quiz also on show or fill rule. So shave the spread. If there's a 40-50 cent spread, a higher price, like the stock which move. Remember that when there is a spread, bigger spread, there's something is going on, because even the market maker doesn't know how to handle this option. So he just goes and create the spread. He's trying to protect himself. So you watch, you don't have to immediately enter in that trade. Look at different strikes, look at different month. If you're buying, let's say you're looking at July option, maybe and the spread is kind of wider, then you go and say, let me see what is happening in August option chain. Maybe let me see what else is happening in other strike, and watch the bid, watch the ask, and you will get proper fill. So shave the spread, put something in the middle, and based on the show and fill rule, you will get fill. So pay attention to the spread and try to shave some spread, and slightly towards the ask. So slightly towards the ask, the market maker will get you fill. He wants you to get out of the, like, get out of my lane. So if the ask is 10 and the bid is 940, you can bid 960, 970, and you may get fill if the contracts are less than 20. So you will get fill. So get something, one or two or three, and okay, I'm done. So don't just buy at 10. If it's trading, if the ask is 10 and the bid is 940, you may get filled at 960, 970. And the reason you get filled is maybe the market maker, that guy, he wants you out. Maybe the stock fluctuates. So he fluctuates up and down, and then you are out. Your order gets filled. If not, then you just cancel it. So here's the guideline I created, and you can, it's in the guidebook. Yes, you can read here. So pay a little extra. It's okay if you know that there is a potential. So don't mind, don't haggle too much. Pay a little extra for some contract, buy more later. So you should have a option. You should have a risk management worksheet, your position sizing worksheet ready, or some math done in your head, or a little calculator. That's why the phone needs to be there with the calculator. Now you don't need an extra calculator from Best Buy or Staples, those big calculators. You just keep your calculator open, your portfolio size, your open position, or do some sophisticated, you can do some math and say, okay, I need to buy these men. I can only put this much dollar into this trade. So when you only can afford to put $2,000 in the trade, especially in option. So in option, somebody asked about the stop loss. In the option, it's very hard to put the stop loss. And the reason is this, and think about this. The reason is this: you are trading stock. You are using option uh, to trade that stock. You're reading the chart of the stock. You're reading all this thing I described to you. All this thing. I described to you the key pattern. You're applying the key patterns. You're reading the key pattern on the stock symbol. You're not applying it on an option chart. You preparing the basket of the stock. You're not preparing the baskets of the option. You are doing the price discovery and applying all the support and resistance and all this gap, up, down, reversal, this, that, on the stock symbol, on the dog and cat and Tesla and Apple. You're not applying these techniques on option. So, when you're not applying all this in option, and let's say you buy sometimes the options are, there's nothing cheap. So the cheap is when you do the analysis. Say, okay, the theoretical price of this option should be is dollar, and I can buy it at 90 cents. That is called cheap. Cheap is not something where you buy a dollar option on a $6 stock. That is very expensive, because $6 stock will move from $6.25, and your option will move from a dollar to dollar or five, and that may be the spread. And if it tanks from 6 to 4, then your dollar option goes to 10 cents or maybe 5 cents, and never recover. So try to understand different option prices should have a different stop loss figures. So if you're buying a dollar option or $1.50, you expect that you can lose all in that position. You may. So when you understand that you may lose all in the option position, or something can happen, somewhere the fights breaks out, something happened and the market is tanking. So when the market is tanking, all the positions are going 3-4% down, and then 3-4% down, and the small caps, they go down 25%, 50%. So if you do that, if you buy a $10 stock option, and the market is tanking, it's going to $6. So that $6 move is a 40% drop in the option, in the stock. That 40% drop in the stock is a wipeout in that option position. So knowing all this, knowing what kind of how much you're paying. So maybe for a $10 stock option, you can put the stop at 50%. But if you're buying a $3 option, and if you put 50%, you may see it going to $1.50, you're getting out. First of all, if you buy a $3 option, the bid is already at $2.80. Your timing may not be right, and most of the not right. We cannot time exactly. Anything moves up, and then by the end of the day, it goes down. So your option already from $3 is trading at $2.60. It could trade $3.60, but it's already trading at 260. And if you put a 25% off stop loss, tomorrow morning it goes down a little bit, and then you're stopped out. and then you see the reversal going, and then it's going to $3, $4, $5. So try not to put the so think about it, how much you're paying for the option, and based on the option levels, then you can put some stop prices. So always remember, you're reading the charts of the stock, not reading the chart of the option. So give some leeway for the option to work. So you have to have some conviction, some conviction in your trade. So if you don't have a conviction, don't put the trade, and then give the time to for that trade to work out an option. And another traders, they make a mistake. They put on a weekly option or just a 2 weeks. So instead of buying a third Friday expiry, they say, I bought something very cheap. First week of option expiry. I bought it July first Friday. I didn't buy your you recommended third Friday. So I say, okay, it's your thing. I may come out winner by third Friday expiry, and your time decay is kicking in. Every day you're losing money. So be aware that option is, work is a double-edged sword. So hopefully you know what you're doing. So if you're trading short term, very short term, like a weekly, then you better be right most of the time, and the gain should be 300, 400% because um, expiry. So pay attention to that. Maybe you can, when you're trading in this range, maybe you can set the stop loss based on this range. But if the option is trading at $4 or less, then it can go to $2 and then it can come back up. So give some leeway. So put the stop based on some technical analysis on the stock itself, not just predetermined dollar amount or predetermined percentage on the option, because most of the time you will be getting out. So so what you can do, maybe you can do the applying the technical analysis on the chart, and then you say if the stock goes below this level, this will be the move from the entry price to the stop loss price, and I expect that this will be the option. So if I'm buying an option at $5, and if the stock goes down and hit my support, that $5 stock option will be trading at $1. So I will lose $4 in it. So then you can buy the number of contracts based on the dollar amount. So this is called position sizing. You understand how much you will lose when technically the stock stops out, and then you put the dollar amount into that position based on your risk level, based on your portfolio size, based on when you get stopped out, how much you will lose. So getting back to this partial execution. So when we get partially fill, you don't need to chase. You don't need to keep the order good till cancel. You just cancel it, and you will get the better price tomorrow at 20-30% maybe. And if it goes above, gaps up, and um, go to the moon, if you have one or two contract, okay, you're fine. So don't leave your buy order forever. Leave your sell order forever, good till cancel, because you can always cancel your sell order based on what else is happening. So, but buy order should be only valid for few minutes. So do that, and always need to know before you put on position, you need to know where is the exit. So in one of the movie, Robert De Niro, he is so I learned this from Robert De Niro. So Robert De Niro is somewhere in Europe. He's a leader of his gang, and then he's meeting another leader of another gang. So this scene is set somewhere in a European city. So before he goes inside the building, he tells his colleague to stay outside, and I'm going to meet the other guy. So then he disappears, and then he came back after 10 minutes. So his colleague asked, "Hey, boss, where did you go?" So he said, "Never enter a building without knowing where you will be jumping, which window you will be jumping out when all uh, um, bad word shit happen. So when the shit is happening, you need to know where you will be jumping out. And when the good thing is happening, what are the good things happening? Where are the target? What is the potential? If there's no potential in the trade, I'm not trading. Doesn't I'm late. So if there's no potential, it means I'm late. Either I'm late in that trade, or the target, that symbol, whether it's a dog or cat, it trades in a narrow range. So it's kind of trading in a very, it's in its own universe. It's a narrow range. A lot of stocks were doing it just now till last week in a narrow range. Like Home Depot is still doing it, Lowe's is still doing it, Nike is still doing it. It's in a narrow range. So if there's no potential, then don't take that trade, or maybe you're late in the party. So understand where are your targets. So figure it out based on your big landscape. Sometimes you can understand the target on a 30-minute chart also, because all the turning points, you don't see it on a day chart. Day chart is just one bar. Whereas in a 30-minute chart, all the twists and turns are there. On a 60-minute chart, all the twists and turns are there. So look at the lower level charts, and see where are the targets, where the turning points happen, and whether you have a potential, and draw the lines on those targets, whether it's the downside or to the upside. So when those targets are hitting, you get some kind of alert, whether it's a visual or whether it's auditory. So whether it's auditory or is a visual. So this is a complete science itself, knowing what kind of a trader are you. Are you a visual trader? Are you an auditory trader? You see the charts, or you want to hear something? Somebody has to shake you up and tell you that this thing is happening. Wake up. So only you know. So what I do, I define it a long time ago. Like, even my little children, they know, they were telling their mother, daddy doesn't stop when he doesn't slow down on a yellow light, mama. So I realized that I don't slow down on a yellow light, and my children are watching me. I better slow down and stop at yellow. So uh, so so this is the concept, to slow down and maybe stop. Don't cross the yellow light. So this is the targets. I give a definition of green, yellow, and red. So first target I call it green, second target I call yellow, and the third target I call red. So I will give you the explanation. Just if you keep in mind in this traffic light, and then it will make sense. And I've been doing it for 12 years. There's green, yellow, and red. So green means green, right? So I give you this definition again every time you attend this session. I give you, I don't know, maybe I've gone to Seattle like 100 times from San Diego in via webinar. So let's say I start my journey from San Diego to Seattle. So if I put something in my GPS and I say, okay, I'm going to Seattle, and I tell my friend, I'm leaving now, coming to see you in Seattle, and then I look at the GPS and it says, I have to really look at it tonight. After this session, I will look on my GPS how many hours it takes. Let's say it takes 67 hours. So the GPS is saying 67 hours is straight. It doesn't tell you, it's not expecting you to take a nap or take a coffee break or go to some gas station or overstay or go on a scenery to Santa Barbara. It's not, it's just giving you exact. So that what it is, the red target. So red target is something out there based on some major resistance, some major targets. So for instance, for AI, let's say it's a $50, or for Tesla, it was a 250. So something is there. So, but AI may not go there at 50. It may take a twist and turn. It comes back, it goes to 45, then it comes to 40, then it goes to 42, then it goes to 47, then it goes to 49, then it comes back. So then it goes to 50. So that's the way the stock is moving. It's something like when you are watching your delivery to happen, like somebody is delivering me food, and I'm watching on the on online. So I'm sitting with my daughter and I'm sitting online. Okay, daughter, this food, he picked up the food is coming, and then I see him going this way. I say, why you're going this way? Come this way. This is the way you need to come. And then he makes a right turn, and then the car shows reversal. Then it goes on the left turn, right turn. So and eventually he lands. Yes, 1 minute, 1 minute to delivery. So the delivery is there. So same way, if he knows the straight road like I know to my home from that restaurant, I will arrive in less time, but it doesn't happen. Same way the stock travels. Sometimes they just keep going and hit the target. Sometimes they take time. But at least just like the map. So you have drawn the internal map. You know exactly where the stock is headed because you did the analysis on a day chart or a weekly chart or an intraday chart. So you need know all the twists and turns, where all the stop sign is, where all the major turning points are. So that is red target, which is, let's say, Seattle. The yellow target is, for instance, maybe you can say yellow target is like San Francisco from San Diego, and the green target is right there. You can say Santa Barbara. So if I put on my GPS, I'm leaving in San Diego, I'm going to Santa Barbara, I will get the maybe 3 hour or 2.5 hour, and I may arrive straight. If I keep going, I will arrive at 2 hours and 30 minutes. So that is what the green target is. So if the stock is trading at 100 and the green target is set at 104, so the stock has a pretty good chance of hitting 104 and in a short time. So estimate the time duration, maybe in 2 day or 3 day, it will hit the green target, and the probability is very high. So the probability for me reaching on time and safely from San Diego to Santa Barbara is quite high than my probability of reaching safe and sound and on time from San Diego to Seattle. So that's what it is. But if I reach if I reach Seattle on time, then I may say, okay, let me go all the way to the border of Canada. Let's see what is there because I have time. So that's the way the stock works. So I define it green target, yellow target, and red target. And then there's something called beyond red target. So beyond Seattle, where else I can go? Maybe I can go to Canada or just at the border. So so when you keep this in mind, so when you're defining your target, so keep that in mind. At least the green target is should be the sure shot. So if you're buying at 100 something, 104 is kind of sure shot that 95% assign some kind of a probability that this target will hit. I am pretty sure that the green target will hit, and it will hit in 1 or 2 or 3 days. So when this thing happen, I get the alert because I set all the alerts. So I drop all the waters. So I get the alert from my system that okay, green target is hitting. Uh, it's okay. So green target is hitting, and sell some. So it depends how many contracts you have. If you are overexposed um, in your position, if you're overexposed, then you must offload some of the. Sorry, I need to get some towel. Maybe you can hear the water. I drop a big bottle of water on my table. So, so the green target. So if you are overexposed, sometimes we do get overexposed in the sense that if the stock, if we bought at 100, let's say I initiate a position when the stock was trading at 100, and instead of going to the green target at 104, it went to 98, and now it's moving back up. Now is it started to move. So in this journey, I may have added more contracts. So when I add more contracts, that was not the initial design. That did not dictate my risk management. So now I know I'm overexposed in this trade. So I may offload some of my position at the green target, which is 104. And then the next target is, let's say, 107 or 108. So I would exit most of my position, or at least 50% of my position at the yellow target. So yellow target is something where you can say is going from San Diego to San Francisco because it has some kind of a resistance. So you need to have some reading from your intraday chart that when the stock hits that target, which I call it yellow, it will stop for a while because there is some resistance. It has done that before in its life. So when you're reading the intraday level charts, 30 minutes, 65 minutes, you can recognize the turning point. So how far it is. When the yellow target is hitting, what would be your profit potential? So if the if there is a distance between the green and yellow is meaningful, then there is a yellow target. So when the yellow target hits, I sell majority of my position unless is accelerating towards the red target. So I send you the alert, sell half or sell majority based on what the stock is doing at the yellow target, and I send you these alerts via email about the targets. The other target, I call it, for instance, so for example, AI. So I give you example, AI. Um, I expect it will hit anytime 49 to 50. So for my AI trade, the target is 49, let's say. So there is a 70% probability of a stock hitting this target. And now it's very close. It hit already 45, 46. So it's getting very close to 50. So after hitting the 50, I expect AI to pull back. So what I will do when it's approaching, even not even reach 50, even when it's 49, I don't care about the last dollar. I would issue you the alert to sell rest or sell all of your AI position. So the members will receive alert, sell all of your position in AI. It can go to 60, it can go to 70, but my reading, so let's say my reading is that after it's hitting 49, 50, it will have some major, let's say major pullback somewhere maybe 43, 44. If it does that and it reverses to the upside, then I would establish a new position in instead of having a 40 strike right now or 42.50. I may buy August 45 calls or whatever it is. So you get the alert when the red target is hitting. Now there are certain things which can happen at the major resistance level. So this is where I'm just expecting the AI to hit 50 and then pull back. But what if it doesn't pull back and it's just making is a drastic move? It's moving in the pre-market. There is so remember this: whenever the stock is approaching a red target, whenever the stock not the red target, whenever the stock is reaching is major price points. When the stock is reaching some major price point, a new news needs to come out. A new catalyst needs to be there. A new momentum needs to be there. Some new sets of buyers needs to come out. Some new members needs to join. Those who were on the sideline or those who were against the trend, those who were short. Something new needs to happen. And magically, I don't know. They release these news at the right time. Somehow the news come out at the right time. So when let's say give you example of Tesla. So Tesla, let's say it's going to 275. So what will happen? Maybe a news come out when the Tesla is hitting 275, and then there's a new catalyst, and 275 is no longer a major resistance. It's now going, let's say, to $300. So when the red target is approaching, some major resistance is approaching, the stock needs to do something. It needs to show its new colors. So the new color can happen in terms of the news. The stock is gapping above. The volume is huge. So some like a cannonball is fired in on a China wall. So not like a tennis ball, something big and huge happening. So when you recognize that, then you need to maybe you cancel your sell order. So when I recognize it, I send you the alert either in the pre-market or during the market to cancel your sell order. It's safe to hold. So safe to hold. And there's another thing. When the stock gaps up and it doesn't hold the level, it means it's not holding the red target. Then I send you the alert to sell immediately. And it happens when there is no follow through. So the gap occurs and the candle is small and the volume is little. The news was not that great. And the stock just hits some kind of a major resistance and just starts to pull back. So for instance, I give you example. For instance, let's say AI. So AI is trading, let's say, at 47, 48, and then so you're expecting 50, and then the next day it gaps up. It gaps up at 49.10 or something like that, and then it goes to 49.40, and it doesn't go anything, and it doesn't move, and then it starts to reverse, and it goes to 49, and it goes to 48.50. So when that happens, I sell. I don't. I don't. because I don't know if it was 49.40, now it's trading at 48.70. I don't know it's 48.70 or I see 47 a few hours later. If it goes above the high of the day, I don't even want to establish a new position. Once I'm out, I'm out. I don't want to establish a new position. I just make a note of the high of the day for this day. If it goes next day high, okay, I cannot chase. I don't know. I don't want to be the last man. I want a meaningful support. So some support, I will figure it out, and that would be the line I draw. And then when it pulls back and it's moving sharply to the upside, that's where I will initiate a new position. Otherwise, I'm not buying it back. So most of the traders, what they do, they exit and then they establish a new position at the higher price. So why did you exit at a price and then you establishing a new position at the higher price? It doesn't make sense. So I give you example. Let's say the AI gaps up, goes somewhere between 49 and 50 in less 2 3 days later from now. Trader exit at 49. They see 49.40, and so I'm talking about the future. This thing has not happened, but maybe you can see it. So it goes to 49.40, and then it comes back to 48.40, and they exit at 48.40. And then it goes to 50 $50.50. The same trader goes and establish a new position at $50.50. So why did you do that? When I mean, you need to be very, very sure that in this new position you have a new strike and a new catalyst and something you're doing, and you're pretty sure that this new position will make money. So don't do that. Be patient. Remind yourself that you exited at 48.50 and it doesn't make sense to re-enter at 50.50. You're it's prudent to enter at 43 or 42 than to exit at 48.40 and then go buy at $50.50. So they chase it because they're greedy at that time. They forget that they are being greedy, and then they close up, they are holding a position in negative. And they were very they were making a lot of profit. They made the profit, they rang the register, but then they open a position which is losing money. So don't do all this. So now the target, so be very flexible in your trading also. So be very disciplined. So being disciplined is one hand, and being flexible is on the other side. So if you see, let's say you're in AI and you seeing the AI breaking $50 or above, then you might want to hold that position. So markets are dynamic, anything can happen. So only your skills will play the role. So trader needs to be flexible. Various reasons to revise the red target. And red target is revised to capture more gain. So I send you the alert saying, okay, the red target is this. So I shift my targets and I give you the new target to revise so you can, if you're holding the position, you capture more gains. And usually this happen during pre-market hours. So I revise the target to the upside, and I do that. I cancel my sell order and I revise it upward. And for the puts, it's getting revised to the downside. And then I just uh, so in my column, let's say in the worksheet column, the 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 green, yellow, and red are there. So I just replace it. And then in the email, you can see it from the green arrow and the red arrow, whether the target is revised or not. So I show the green arrow. So if you see the green arrow, you know this target is revised to the upside. And then there's a text. And the target may also shrink. So this is another thing. Just like the universe is expanding and the stocks making their move, their expansion. So for instance, the AI is is expanding in its target. The stock can starts to the target can start to shrink, and the shrinking happens when the stock doesn't want to move. It goes up, then comes down, goes up and come down. Then it creates a range. So when it starts to create a range, like for instance, a J and J, when the stock starts to create a range, I exit. Um, I just exit because the cost, time value of the money, opportunity. So, for instance, if Uber is going up, going down, going up and going down, and I already have 30% profit, so I just take profit. Same way for J and J, if I have a 30% profit and it's going up and going down, okay, I exit. Another example I give you, Cisco. So when I entered the Cisco, I expected to go to 53, but then it got stuck at $50.70. And I look at my profit and I say, okay, I've been holding this position in Cisco for 7 days now. Only have 25% profit, and is the whole market is moving, but the Cisco is not moving. It will go, but it's not moving right now. So I exit and I put my money somewhere else. So the targets may shrink, and the profit potential may shrink. So you need to be flexible in analyzing. Um, Another thing I do and you need to do is how many days you have been holding this position. How many days you have been holding the position, how many days left into expiry, when is the earning coming up, how many days left into the earning, when is the next earning, when the past earning happens. All that data needs to be available to you so you can make some decision on the trade, and what is the profit you have, and what kind of a target is hitting, is what kind of a resistance you are facing in this position. So all that analysis needs, I do that. So it's all there. So I send you all the alerts depending on what I did in previously, what kind of alerts I sent you, whether I sent you alert to buy more, or whether I sent you alert 1 day ago, or I sent you the alert 10 days ago. So I give you all this kind of alert: sell one third, sell half, sell majority, and I document it. So I have the documentation of what I gave you as a sell alert. So based on what I have a matrix, and I give you the next alert. If I have given you sell half, give you the second alert to sell rest or sell the other half, all that. Now, another thing, sometimes the stock, so I give you another, I give you example of AI. So let's say 3 days now, 4 days now from now, AI is moving in a rapid fashion. Let's say it's moving. Oh my God, it's just crazy. It's going up. It's now at $50.80. It's now at 51. It's now at 52. Whatever it is, and it's Friday. So only 1 hour left. So it's Friday, 1 hour left. AI is moving crazy. I don't know. Maybe it's going to 25. I don't know. I'm just giving example. So Monday is a holiday. So I say, okay, Monday is holiday. It's a long weekend. I'm already up in this. I don't know. It's just going extreme, but I don't know where it will end. So I give you a range. I say, please sell AI or all your call between 50 and 51, or 51 and 52, or 48 and 50. So something like that. I give you the range. And as the market is closing in, I give you a tighter range. And then sometimes I give you sell to close by market, meaning just close this position by market. Sometimes we are losing money, so the stock is recovering. So let's say the recovering, losing, and the loss gap is narrowing down. Right now I'm losing 20%, then I know is 15% left, and I know is a 10% loss left. So but I need to close it, so I send the alert to close it. So better to close on Friday when there's a long weekend, and I was holding this position for a while at a loss. So close that position. So another one important thing, when you have open position, you need to monitor those position in the pre-market hours, because a lot of things are happening in the pre-market hours, especially when the market is bullish or bearish or something like that. The strength is there. So pay attention to the pre-market levels and note down. So I do that. So you see a lot of work goes on in the trading, and if you say, oh my God, you do a lot of work, so I don't know. Yes. So pre-market levels you need to monitor, high and low. And then when the regular session open, the stock should, if you have a long position and the stock is gapping up during the pre-market hour, then that stock should move above the high of the pre-market hours. So note down that level, and uh, even when the market is not open, you know where the stock is trading. So just visualize that when the market opens, it should land at this price point on my daily chart. So you can visualize it that this is where the stock is should land on my daily chart. So if it land there, then you switch it. When you see it for 5 minutes, you can see it now. It landed. It's like the twinkle twinkle little star, and it just lands there. Sometimes the twinkle twinkle little star become a huge bar. So that's what you want, a huge bar. If it just sit there in a little like a dot, and you flip your chart on a 5 minute and you say, okay, there's no follow through, I better close this position. So you can close the position. So pre-market hours action needs to be monitored, all the levels needs to be monitored. So I send all the target updates during a pre-market hour. So you receive between 6 and 6:30, you start to receive like 5 6 emails on the updates on the various positions. So I do that. I also tell you when to add more to the position, because adding to the existing position is a good strategy, especially when the stock is moving to the upside. So if the stock is moving to the upside, you may, instead of exiting from the position and locking the gains, be patient and see if this position merits, uh, based on your risk management also, and you don't want to overexpose, whether you want to add a new strike, whether you want to add a new month. So if you already have a July strike, you don't want to put open and add a new to the July, because July is very close, so you don't want to add. So maybe you buy August calls, maybe you want to buy a new strike because already rapidly you are already in the money, so you want to add to the new, add a new strike, maybe little one strike out of the money, new month. Maybe you want to buy some shares, you just add, you say, no, I don't want to risk any more money via option. I can open another account. I have another account where I trade stock. I open that account and I trade stock and I put, buy some extra shares. Maybe I can sell some puts. Whatever you do, you need to have. Maybe I sell a short call against my long call. So I lock my gains and I create a vertical spread. So all this is a strategy. So all these are strategies. So it depends what strategy you're adopting. It's the same symbol doing the same thing, whether it's a dog or cat or AI. And different traders doing different things, different depending on their age, depending on their financial objective, depending on what else is going on in their life. So and then I send you, if there's any news update, I send you, I write articles, I do the research, I give you fundamental analysis, why the reason for fundamental reasons for this trade. And then I constantly send you update to log gains. And then when I send you the update to buy more, this is the way I send you. Meta calls July 2:30, buy more at 6. So if you bought one contract at 10, maybe you buy two contract at 6. So put equal dollar amount. So if you bought one at 10, you're buying two more at let's say $1,200, two contract. So now your average cost comes to $7 or something. So I don't give you the alert. So don't do the averaging just for the average sake. So don't do that. People trade, they buy at 10 and then they say, it's trading at 950. Can I add more? So what you are trying to gain when you already bought at 10 and now you're buying at 950? How much, unless you bought one at 10 and you're buying like 100 at 950, then your average cost will be 950, but then it's not prudent because you're over too exposed. So don't buy, just don't average down just for the sake of bringing your average cost down. Don't do that. Buy at the technical level, buy some new catalyst. Ask yourself, if I was not in the trade, would I initiate a new trade at this level at $6? If the answer is yes, then you average down. Similarly, if I'm not in the trade and I see AI moving, would I have initiated a new trade? If the answer comes yes, then ask yourself that, okay, now what I do I buy another strike another month, or the same strike and same month? Or do I buy shares, or do I sell short calls? Is it in a margin account or is it a cash account? So all that you need to pay attention. So capitalize, especially capitalize on both sides, whether the averaging it down or averaging it up. So, and then the last thing before we go is something I use called conditional order. So I used to do that. I don't do right now because I am I'm in the office all the time, so I'm there. I can monitor my trade. But when I was not, so I was working as a consultant and I had open position and I wanted to set my orders. So this is what I learned in interactive brokers. They call it conditional order trade station called activation rules and all. like all brokers have this features where you can set your option to sell option based on the targets, a stock target. So think about this. You're trading, again, you're trading the stock. It's just that you're using the option to trade, which is a derivative. So the underlying is the stock. So if the underlying is the stock, you don't make your decision based on the option, like, okay, when it's 40%, I will sell. If that's what your data is suggesting, on average, the option moves 40% gain, then maybe you can set the target to 40%. But your buying and selling decision is based on the stock. So that's why I do calculate a rough option price based on the yellow target, and I give you the estimated option price so you can set it. But actual selling should occur in your option based on when the stock is hitting the target, whatever target it is. So there is something called conditional order, which you can set that when the AI hits 49, sell all my contracts at market price when the AI hits 49. So if you set this conditional order, uh, the AI, all your contract will be sold at market price. And so if the option is not liquid, then this is not a good strategy. If the option is not liquid, if the spread is narrow, because the market price could be anything. So the last price could be you get filled at the last price, which could be they sell you at the last price. So your order becomes a market order, and then you get filled. But so the conditional order is good when the spread is very narrow, the stock is very active. So if you don't know what option price would be, you set your sell order based on the conditional order. So the conditional order could be anything. You can sell Apple option based on Baidu target, or based on SPY hitting this target, or based on QQQ. When QQQ hits 400 or 500 or whatever, sell all my NASDAQ stocks. These are my stocks options. Sell based on QQQ hitting 500 or whatever it is. So, so conditional order work that way. So at least go and explore the conditional order and practice in your simulation account. Make sure that you are not setting it incorrectly, because you will get filled fast and you may lose money. So be practice a little bit with one contract in a simulation account, and then you can implement it if you are unable to watch during the market hours. So these days you have a phone app, and you can basically you can watch. These are some of the winners. So I'm just giving you, if you're a member, you already know. So these are some of the winners. Then what else I have? So that's the end of this session. There is something called dollar cost averaging. So I'm showing you the slide. I will explain to you later. There is a beauty in the dollar cost averaging. So I'll explain this slide later. I prepared. I got this from somewhere, but I'll explain to you later. So this concludes today's session. If you have any email or any questions, send me email, and I'll let me read the question which Juan came was bombarding me, and I told him to stop, so he left. I don't do forex trading. So again, this is what. So in the beginning, when I was learning, so I had a mentor named Chief. The first mentor I had was the name Randall. So he was from Costa Rica. So he guided me. So there's a story behind. Then I met somebody named Chief. So during that time, there were software boxes. I'm sure it's this time too. So they were the same software box. They were just renaming it and putting the data feed for that market. So for instance, they were saying it, okay, this software is for stock. The same software, they said, okay, this software is for option. It was the same software. They just incorporated option data, and then they call it a different, and then they said you have to pay another 3,000 for this. Then they created another software, the same software, they call it for forex. So buy this software, and they fed the data for different currency pairs, and they said, okay, you can buy this. So this is for commodity, this is for pork belly, this is for this, that, and they make a package like $25,000, and then they say, okay, auto trade, you don't have to do anything, just set it and forget it and let the money roll. Now they are not in the business. So I asked Chief, I said, Chief, Should I buy all these software, $25,000? They're saying I can set it, forget it. So he asked me to stop trading, don't do forex trading, etc. I mean, you can make money, but so what do you want to do? At that time, I was a consultant, so I said, no, I cannot even trade stocks. And he said, yes, right, you cannot even trade a stock properly. So you want to trade futures, you want to trade commodity, forex, etc. So don't do that. So somehow I never learned forex. Although I have a degree in MBA, I have an MBA in finance. I can pick up. I mean, I can pick up, but I don't. I'm just happy with the stock trading. So if you cannot succeed in stock trading, it's very hard to succeed. I don't know. Maybe I'm wrong, but if you cannot succeed in stock trading, it's hard to succeed in other like forex, commodity futures, etc. So I don't know. And then first, people go backward. So I started trading option without knowing anything about myself. I still don't know about myself, but without knowing the market, without understanding the chart, I started trading option. So that's another mistake people make. They just jump in right away into option. They learn the fancy strategy. They enroll in different institute. They learn iron condor, butterfly, and ratio back spread, and this and that. But then you say, okay, yeah, I understand the mechanics. I understand the mechanic. But who is telling me when to put what? Which leg I need to buy? When? What? How do I read the chart? So if you don't understand to read the chart, how can you say, okay, I need to buy a put now. I have a call now. I need to buy a put. I need to buy two. I don't know. I need to sell two contracts against this one contract, and I need to buy this. All this you can learn if. But the main thing, the core thing is the analysis of the stock charts and the analysis of the market. So if you don't understand the market, if you don't understand to read the chart, then all these strategies will not work. So if you are master of reading the charts, if you're master of reading the market, then you can, and then you know your risk management, then you can learn all these strategies, and then it will help you. But for me, Forex, I don't know, maybe I don't have time to learn. So I'm busy with uh, doing other things and trading stocks and options. Okay. So, uh, so somebody asking me what trading you do. What trading I do? I've been explaining for 2 hours what trading I do. I trade stocks and options. Can you touch on a spread? So Piyush, spread I will explain. There's another is a spread is a complicated is another complete field, but I do have a vertical spread. So a spread is the it's a spread. You buy, you go long on one, and then you short the other strike. So there's a strategy, and I will explain. For there's a different webinar I have, different content. So understanding the spread, there's aggressive spread, and there is a non-conservative spread, and then there is a middle ground. So it depends on where the stock is. So recently I put a spread on Tesla and Caterpillar, and it was an aggressive spread. So it depends what kind of the move you expect, whether aggressive or conservative. So then you put the spread. The more aggressive you put, the more money you make. But you can lose all your investment in that trade if you are aggressive in that trade, and the aggressive move doesn't work. So different strategy for different time and what you expect from the stock. So vertical spread called a bull call spread, a bull put spread, or bear put spread. So I do that, and I have a service for that. So it's a different topic. So I will explain later in more detail. Uh, what determine either swing spread along the stock, and do you sometimes execute both at the same time? So what determine either swing spread? So uh, so the spread is, well, so you put on the spread. If you so you put on the spread when you don't have a time, let's say you don't have a time to monitor. So swing trading requires time, dedication. Spread trading doesn't require much time. So you open up, there's a long strike and there's a short strike, and you let the stock do its thing. You eventually know. Let's say you give you example of AI. So let's say the AI is trading at 40. So you can monitor, you buy long calls at 40 and you can monitor it, do its thing every day, boom, 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 it's moving up and down and you're monitoring it and you don't want to lose and you want to add and all that thing going on in the swing trading. But if you don't have time, then you say, okay, I can buy long calls at 40 and then I can sell the short strike at, let's say, at 50. Because and the reason you're doing it 50, because you're creating a bigger so this is another topic I'm going. So just give you one example. So it's a 10-point spread. So when you will make the maximum gain when AI moves beyond 50 or reaches close to the 50 by expiration. So it requires little time. So imagine putting on the trade and then forgetting it and setting the order to close your spread position when AI goes to 50. So that's where your gain will be maximum. So you need to do some study while you have a option open. Let's say you don't want to do a spread, you only have a long strike 40, and you have another account where you have a account to where you trade stocks. So when the stock is doing its thing and it's like AI, maybe you can buy some shares, because buying shares, even when you in option, when you may run out of time and the AI can do its thing and it's going up, so it's worth having the stock, some shares in your portfolio. But that account is a different account. That account is for your position trading or for your retirement account or your long-term account. So something is there, you're holding it. And then when you're buying shares, you can do the covered call. You can sell the puts. I have a friend who sells the puts. He goes and sell the puts at the right time and collect the premium. He sells the weekly puts. He's doing it for those stocks which are active. So these days he's doing it for Tesla. He does for Apple. Sometimes he get assigned like 5,000 shares of Apple. So once he gets assigned, because he collected the premium, now he gets assigned because Apple pulled back. So he goes and starts selling. He converts it and starts selling, doing the covered calls. So he started making money on the covered side. But for him, this portfolio is a bigger portfolio and is dedicated for stock trading. And then he has a smaller portfolio for option trading, which is speculative trading. So you can do all this kind of a strategy. You can sell puts, you can sell calls, you can buy calls, you can create a spread, or you just go buy straight long calls and long puts. How much money do you need to start using your system? So, uh, so, so there, so trading trading requires capital and commitment, and then there are other C's. So there's another session I have. I will talk. So capital and commitment. So the bigger the capital, the traders who make money, those who have the higher the capital, the higher the chances of your success and over the long run. The smaller the capital, the less chance you have in over the long run. So if you have only 5K, then you better buy small price options and you don't have a leeway. If you have only 5,000, when people send me emails saying, I have only 2,000, can I trade with you? I said, no, please don't trade with me. Don't subscribe to any of my service if you have $2,000. If you have $5,000, then maybe Swing Light. So Swing Light, I send you a smaller price, $5 or more. But then again, imagine this: if you have $5,000 portfolio, and I send you a trade, let's say a $5. So you buy one contract, you're putting $500. So you put in $500, which is a 10% of your capital, which is a very high risk, because 10% of your capital. And in option trading, you can lose all that 500. So when you put 500 and that is the 10% of your capital, you are a gunslinger. So in other words, if you are trading uh, if you're trading swing light, you need to have at least 10,000. So in other words, if you put 10,000 and you buy one contract for $500, that is a 5% risk you're taking. You're assuming that anything can happen and that position can go to zero. So that 500 can go to zero. When 500 can go to zero, and if you have a $10,000 option portfolio, then that means you lose 5%, which is still a little higher than recommended 3 to 4%. And then you don't have a leeway to add more to the position. So if you initially bought one contract for 500, then you don't, the moment you start adding more to that position, you may make money. It goes up, and then you say, "Oh, I'm damn lucky. I bought 500 and I bought another two at $3. So $3, 600 and 500, $1,100. So you had a portfolio of 10,000 and you put $1,100 in that portfolio, which is more than 10%. And if it comes out, you close it at the gain, so that 10%, $1,100 go to $2,000. So now you have a portfolio of 12,000. But imagine if that position did not work out. So out of $10,000, you lost that 1,100. So 1,100, and then and you will lose by. You may you not you will lose. It's just the emotion is to kick in, because the smaller the portfolio and the position, you don't want to close the position in loss, because it's a psychology. That is 10% of your portfolio. So you don't want, compared to of someone who has a $30,000, 50,000. So for a person who has a $50,000 portfolio and he's putting 500 or 1,000, his no, the percentage is very little compared to the overall portfolio size, and then he has a leeway of adding more to the position. So my answer is, if you have a 5,000, you can try swing light. So swing light is the service. So another thing you have to think. So $5,000, you have a portfolio. You're giving it to, you're buying and selling. You're giving the commission to the broker, unless you have a broker who doesn't charge you. My fee subscription is 147. So you're paying me 147 per month. So 150, you must make 150. Let's say, so 150 goes to Noshi, and then you are putting some time, unless you have a job somewhere and you're doing it, this is your side gig, you're doing it only on your phone, so it's okay. But if that's all you're doing, sitting at home, and you're trying to make some money from 5,000, so it's better that you go and find a 18-hour job, which will make you, on 8 hours, you will make at least maybe 150, $200 per day, than trying to make money from option trading with a $5,000 portfolio. That's why I don't try to encourage. So it's okay. I have a swing light, but when I send you the marketing letter, I send you for the yearly. I send you for 897 for the 7 month, etc. So, so, so I am like that. All right. But if you have a 5,000, you can try swing light monthly and see how it goes. So for swing light, I send the alert $500 or less, 300, 200, 400. And for swing option, I send the higher price options also, and this also. Then I have other services also. You can go on the website and see it. All right. So what else? What portfolio size should you allocate to trading full time? What portfolio size should you allocate to trading full time every day in option? So okay. So think about this. Trading is not a hobby. Trading is a business, and you're out. You need to allocate some time to some dollar amount to your time, unless you're doing gardening. Like I have a member who, let's say he or she is just doing the gardening, so they don't allocate any time value to their hours. So if that's but other than that, you have a internet expense, you have a TV expense, you have a subscription expense. You can put that money into, let's say, CDs these days, 3 month, 5%. So you say, okay, I don't take any risk. I can put the money in Treasury. I get 5% or something like that. So at least I will get that. I don't need internet. I don't need the phone. I don't need to subscribe to Noshi. I can just go do the gardening. So all of this you're doing, when you put allocate some dollar amount, then you come up with some break even point. Then you say, okay, break even is this. So, and then you divide by the hours. So, so whatever hours you put in the year, let's say there are 250 days, multiply by 8 hours or whatever it comes, 1500 hours or whatever it is. I don't know, my math is poor. So just multiply 250 days and you invest 8 hours a day. So 250 multiplied by 8, or let's say you put 10 hours. So 250 days and 10 hours come to 2500 hours. So you spend 2500 hours over the year. So then you say, okay, my 2500 hours is worth, let's say $20 an hour. So whatever that dollar amount comes. So you say, at least I need to make $20 an hour over the year. So then you know how much capital, then you figure it out, the return, and then you say, okay, if the return is 30% I expect over the year, then this should be my portfolio size. This portfolio size, based on this dollar amount I expect, based on the 30% return, this should be my portfolio size. So do this all this math. So consider trading as a business, not as a hobby. So do your analysis of your hourly rate, do the analysis of all your expenses you're incurring, including this subscription cost, including the time you spend in learning. Like right now you are here, even though it's free, but you could have been watching Netflix or something. So do all that. You may be, I don't know your background, you may be selling something on Amazon, or just doing some gardening, whatever it is. So come out with some plan. No, I don't take any percentage cut. So just the service. I don't have any percentage cut from the your profit. I have no way of, so I don't manage anybody's money. So I don't know. I'm not a licensed. And the drawback is I don't know how much you're making. So I don't know your portfolio size. Some have 1 million, some have 10,000. All right. So I conclude, and I will see you in few days with another topic, and I will teach you something. All right. So if you have any question regarding subscribing to any of the service, please reach out to my team, success@tradegenie.com, or just hit reply to any of my email. Another thing, before you go, I have a short course, 8-day course, which is called Duplicating Success. It's worth tons of money. And I can see from your email and etc. or your question. Uh, I'm just asking you to pay $297 for that 8-day course. So if you're interested, I teach something else for 8-day, 2 sessions per week, total of 12 hours. So it's a 12 hours course, and send the email and I will teach you for 297, and I learn it by paying a heavy price. So, and doing a lot of research, and going under mentorship and coaching with the top-notch hedge fund coach and hedge fund trader. So I learned from the person who taught the big boys, and I learned from person who ran hedge fund, very successful commodity hedge fund. So I learned, I paid a big price to learn this, and I condensed, not all, I cannot teach you everything in just 8 day. So there's a short course I have for 8 days. So it's only 297, and I'll be teaching it soon. So if you're interested, send email to my team and they will enroll you in that 8-day course. It's called Duplicating Success. And I'm sure you don't know anything what is inside that course. All right. I can guarantee you 100%. And if you know that and you say, oh, no, she did not teach me anything new, you can ask me for full refund, and I don't I just issue you refund. I issue refund right away. I mean, if somebody asks, I say, okay, here it is, take your money, go, bye. I don't haggle on all this. I have other bigger things to do in my life than to haggle over 297. So I don't do that. All right, I'll see you in few days. Yes, it is same, Mika. You enroll. Yes, yeah. I hope you learn something. I provide a lot of resources. I provide some guidance on it, and it's up to you how much time you spend to further improve your trading and other things. Thank you. Bye.